Fixed income, cash, money markets, and growth stocks. Who else is getting shafted by higher than expected inflation? Flint West reporting. Everybody talks about inflation. Everybody talks about money printing. Everybody talks about rates. But very few people stop and ask a much deeper question. What if the measuring stick itself is broken? Because if you're using the wrong yardstick, you'll arrive at the wrong conclusion. And that might be exactly what's happening right now. Section 1. Since 2020, official CPI inflation has risen from roughly 100 to around 130. Most people look at that and conclude inflation has been bad but manageable. But what happens if we stop looking at consumer basket inflation and start looking at what it actually costs to maintain civilization? Energy, food systems, fertilizer, logistics, infrastructure, the pipes, the wires, the trucks, the ships, the physical machinery that keeps modern society functioning. That's where the Purchasing Power Stress Index, or PPSI, comes in. And the picture looks very different. While CPI rose from roughly 100 to 130, PPSI surged from roughly 100 to 265. Let that sink in. One measure says inflation is up around 30%. The other says civilization maintenance costs have increased by more than 160%. That's not a rounding error. That's a completely different reality. Let's make it tangible. Imagine you started with $100 in January 2020. Under the CPI framework, $100 becomes approximately $76.92 of purchasing power. Painful, but survivable. Under the PPSI framework, that same $100 becomes roughly $40. In some calculations, closer to $38, not $77, $40. Suddenly, the conversation changes. Because now we're not talking about inflation, we're talking about wealth destruction. And that's before we get to the bond market. Section 2. The bond market is supposed to be one of the smartest information processing machines on Earth. Trillions of dollars, institutional investors, pension funds, insurance companies, central banks. Yet time and time again, it keeps making the same mistake. As of late May 2026, the 10-year Treasury yield sits around 4.56%. The 10-year TIPS yield sits around 2.1 to 2.2%. And the market is implying approximately 2.4% average inflation over the next decade. Sound familiar? Because we've seen this movie before. In May 2016, the market expected roughly 1.8% inflation. Actual inflation averaged around 3.2%. In May 2021, the market expected roughly 2.4% inflation. The next 5 years averaged around 4.5%. Again and again, the market underestimates inflation. Again and again. Bondholders get shafted, and yet the cycle repeats. Why? Because the market continues measuring reality through CPI. But if CPI understates what's happening in the real world, then every downstream calculation built on CPI becomes suspect, including so-called real yields. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 3. Now we get to the most interesting part, the 10-year TIPS chart, the DFII 10 chart. There are 3 major periods where real yields approached zero or fell below it. Around 2012 to 2013, around 2015 to 2017, and again during 2020 to 2022. For the purpose of this discussion, let's call these periods what they really are, flush periods. Because that's exactly what's happening. Purchasing power is being flushed out of the system. Cash holders get flushed. Bondholders get flushed. Money market holders get flushed. Retirees living on fixed income get flushed. Savers get flushed. Anybody relying on nominal dollars gets flushed. And here's the kicker. Those charts are using CPI, not PPSI. Think about that. The official chart already shows zero or negative real yields. But those real yields are calculated using a metric that may itself be understating the true erosion of purchasing power, which means the flush may be far deeper than advertised. The chart says you're ankle deep in water. PPSI says you're already underwater. Section 4. So who gets hurt? The obvious victims are fixed income investors, treasuries, corporate bonds, municipal bonds, certificates of deposit, annuities, anything paying a fixed stream of nominal dollars. Cash holders get hurt. Money market funds get hurt. Long-duration bond funds get hurt. Growth stocks often get hit as well. Not necessarily because they're bad businesses, but because future cash flows become worth less when discount rates rise. Even TIPS investors aren't completely protected. TIPS are linked to CPI, not PPSI. They protect against official inflation, not necessarily against the full cost of maintaining civilization. And on top of that, investors still face phantom income taxation, so even the supposed protection has limitations. Section 5. Now let's flip the question. Who benefits? Who survives? Who has a fighting chance? Generally speaking, the winners are the assets closest to the source of the stress itself: energy, commodities, productive farmland, infrastructure, logistics networks, physical assets tied directly to the inputs civilization depends on. Because when upstream costs rise, these assets are not merely victims, they're often beneficiaries. They're sitting at the source of the pressure. Gold deserves consideration as well. Not necessarily because it's an inflation hedge in every environment, but because it functions as a monetary confidence hedge when trust in financial assets begins to erode. The broader point is simple. When civilization maintenance costs rise, ownership of civilization maintenance assets becomes increasingly valuable. Section 6. And that brings us to the central insight. The story isn't really about CPI. The story isn't really about bonds. And it's not even really about inflation. The story is about measurement. Because if you measure reality incorrectly, you'll misprice risk, you'll misallocate capital, you'll misunderstand what's happening to your purchasing power, and you'll be shocked when your portfolio fails to keep up. The PPSI framework suggests that a large portion of inflationary pressure is occurring upstream, long before it fully appears in consumer prices. That pressure eventually moves through the system. It squeezes margins, it raises prices, it distorts bond markets, it erodes purchasing power, and ultimately it reshapes where capital flows. Which means the chain looks something like this. PPSI rises, civilization maintenance costs rise, margins compress. Consumer prices eventually rise. The bond market underestimates inflation. Real yields become less real than advertised. Traditional portfolios suffer. Investors move toward upstream assets. That's the PPSI chain. And if that chain is correct, then many investors are still looking at the wrong end of the problem. They're watching the symptoms, while the causes are already moving through the system. And by the time the symptoms show up in CPI, the damage has often already been done. Flint West, signing off.